discussing the basic accounting understanding that they might ask and test during your placement interview. In today's session, we are going to focus on the basic finance. So what I'm going to cover is certain concepts of financial management. For the purpose of training, we'll keep it very short. So I'm going to introduce the concept. It is always advisable that you go back and look at your textbooks or notes for a detailed understanding. So the first fundamentals that they generally test during the placement interview is what is the time value of money. So obviously the definition of time value of money is rupee today is more valuable than rupee in future. The entire foundation of finance is on the basis of time value of money. Now a rupee today is more valuable than a rupee in future. The reasons for it is, number one, if you have money today or rupee today, you can use it for the consumption purpose today. Second, money can be invested today and it can generate positive returns in the future. Third, future is uncertain. So the cash flow from the future is also uncertain. And that's why people will prefer rupee today. So if I give you an option to have a rupee today or rupee after 2 years, you're definitely going to exercise the option to have rupee today because you can use it today, you can invest it today, and you may not know that after 2 years what will be the value of that rupee or whether I give you that rupee or not. That's why you will prefer the rupee today. That is the fundamental concept. One more understanding is the purchasing power of rupees today is higher than the purchasing power that rupee is likely to have in the future. So if you can buy more stuff today from the same dollar or rupee, which you may not buy in the future. So because of all these four reasons, a rupee today is more valuable than rupee in the future. That's the basic concept of time value of money. Now, there are three rules of time travel. So whenever you are evaluating any cash flows in finance, you have to understand rule number one, only values at the same point can be compared or combined. So let's say you're getting $1 today and you are getting $1 after 1 year. Now you cannot compare these two $1 amounts because they are in different periods. So either you have to bring the future value into present or either you have to push the present value in the future. So rule number two is to move the cash flow forward in time, you must compound it, and to move the cash flow backward in time, you have to discount it. So what is happening is the same dollar which is received today, let's say you are in year zero. So I'll draw the timeline for the benefit of class. Let's say this is period zero and this is period after 1 year. And you have $1 today, let's say. And you also have $1 after 1 year. So the time value of money concept says that even though the amount $1 is same, still you cannot compare it because this $1 is today and this $1 is likely to be received or paid after 1 year. Since the time period are different, the rule number one, only values at the same point can be compared or combined. So this is in year zero, this is in year one. You cannot compare or combine it. So to move the cash flow forward, you must compound it, and to bring the cash flow backward, you should discount it. This is the fundamental rule of time travel, and based on which the entire time value of money concept is based on. Now, whenever you understand time value of money, there are two important concepts that you need. Sorry, people, I think I lost the connection. I'm sorry, I lost the connection. So, can you confirm whether I'm audible or not? Okay. Just one thing. I think I was explaining time value of money. So I'll just repeat from where we stopped, right? And then we may proceed. So what I was explaining is compounding and discounting. So when you want to find the future value of any amount invested today, you have to do something called compounding. And when you are interested in knowing the present value of any amount today, you have to do something called discount. Okay. So compounding is the process of finding out the future value of any amount invested today. So suppose you invest $100 today at 10% for 2 years, you will get something called a future value, which is 121. And discounting is reverse of compounding. When you already know the future value, but you are interested in knowing the present value. So how much is 100 to be received in 2 years worth today? So you already know the future value, but you are interested in knowing the present value. So it is 82.64. Now, these are the types of cash flows that you are likely to observe: simple cash flow or lump sum, annuities, and perpetuities. So, annuity is a constant cash flow occurring at limited period, occurring at regular interval, but for a limited period. So, few examples of annuity could be insurance premium or equated monthly installment. Perpetuity is basically a constant cash flow forever. So theoretically, perpetuity exists. Right now, there is no asset which could be used as a perpetuity, but still perpetuity formula is extensively used for the purpose of stock valuation when you apply a constant dividend model. Growing annuity and growing perpetuity are basically annuity and perpetuity cash flows, but they are growing at certain rate G. So these are some of the cash flows that you are likely to observe. And if you remember the present or future value mechanics from the first year, these are some of the formulas which you must have used or learned. So simple cash flow, this is the discounting to find the present value. This is the compounding formula to find the future value. Then in case of annuity, this is the present value of annuity formula. This is the future value of annuity formula. Then growing annuity, you have present value formula. Then you have perpetuity, and then you have growing perpetuity, which is expected cash flow R minus G. So one of the question set that you can expect from the time value of money is defining time value of money. What are different kind of cash flows, and can you give the example of certain kinds of cash flows? These are some of the frequently asked questions from this topic. The next is stock and bond valuation. So valuation is something which is extensively tested in all the placement interviews. So basically, valuation is the process of finding out the economic worth of any asset, right? How much you should pay to purchase that asset. And economic worth is nothing but the future value or future cash flows that an asset is likely to generate. So if you invest in any asset, it is likely to generate certain cash flows in the future. If you discount all those cash flows and make it into a present, that is the price that you should pay to purchase the asset. That is the essence of the valuation. So value of any asset is equal to present value of all future cash flows that it is likely to generate. Now, what are three key important inputs for valuation? Number one, you need future cash flows. Number two, you need timing of the cash flows. When are they occurring? And number three, you need an appropriate discount rate to discount those cash flows to find the present value of all these cash flows, right? So now let's move to something called bond valuation. So bond terminology, obviously there are certain terms when you try and value bond, it's very frequently used. The first term is par value or face value. So par value or face value is the price at which the bond is issued. Normally it is 1000, but it may depend upon the type of bond that you're going to issue. So par value or face value is the price paid to purchase the bond. It is also called the issue price. Then coupons are basically periodic interest payment that bondholder receive. Let's say you have invested in a bond with the face value of 1000 and a coupon rate of 10%. So 10% of 1000, $100 you're going to receive every period. Maturity period is the period after which the bond matures or repayment is due. So normally government bond could be of 10 years, 20 years, 30 years. Maturity is when the bond matures and the borrower has to repay the principal amount to the person who has invested in the bond. Then market price is the current market price of the bond. It can be different from the purchase price. Discount rate is the interest rate through which the bond is discounted. And the most frequently asked question in bond valuation is what is YTM. So YTM is called yield to maturity, Yield to maturity is basically the rate of return that investor is likely to receive if he buys the bond today and holds the bond till maturity. So if he's buying bond today, he has to pay something called a market price. And if he holds the bond till maturity, he's going to receive something called a par value. So the theoretical return that he's likely to receive based on the current market price is called YTM, or yield to maturity. Now, how bond can be valued? So to value any asset, you need to value the cash flows associated with that asset. So when you invest in bond, the cash flows that you are likely to receive is coupon payments. So you will receive periodic coupon payments, and on the maturity, you will also receive the principal back. So these are the future cash flows associated with the bond. Now, you discount that cash flows with an appropriate discount rate, which is generally YTM, to find the present value of the bond. So if somebody is asking how bond can be valued, the answer is the present value of bond is function of all future coupons plus principal repayment discounted back to present, right? So C is the coupon payment, and 1000 is the principal repayment, and R is the discount rate, which is appropriate discount rate to value the bond. Generally, bond is valued with the discount rate, which is YTM. So coupon is different and YTM is different. Coupon is a book value measure and YTM is a market value measure. Now, what can change the bond price? So we know that bond price is the function of coupon rates and the interest rate, which is discount rate or YTM. The only way the bond price can change is either coupon payments change or the rate of interest change. Normally, coupon payments are constant. So the only way the bond price can change is if there is a change in the discount rate, oblique YTM, oblique interest rate. So if interest rate changes, the bond price changes. So one question that you might expect is, generally they ask, what is the relationship between bond price and interest rate? The relationship is inverse. If interest rate goes up, the bond price will go down. And if interest rate goes down, the bond price will go up. That is the relationship. Okay. Now, the term which is frequently asked in the interviews, what is YTM, or yield to maturity? So YTM is the rate of return an investor earns if he buys the bond today and holds the bond till maturity. YTM is considered as a long-term bond rate expressed in an annualized percentage rate. The calculation of YTM takes into the account current market price, par value, coupon interest rate, and time to maturity. It is also assumed that all coupons are reinvested at same rate. So whenever you go back, just look at the formula how YTM is calculated, right? Sometimes it is simply referred as yield. So yield on bond is YTM. So that is about the bond valuation. Now, second is preference shares. So one of the frequently asked question is, what is the difference between equity share or common share and the preference share? The answer is very simple. Preference share has preference in two things, that they will receive dividends first and then equity shareholders will be paid. And in case of liquidation, they will receive the money first and then equity shareholders will be paid. So preference shares have preference in receiving the dividends and receiving the principal money back in case of liquidation over equity shareholders. They are also called hybrid of equity and debt. Hybrid is something which has the characteristics of both equity and debt. The equity characteristic of preference share is the ownership, and the debt characteristic of preference share is fixed payment of dividend. So they are also called the hybrid. Now, common types of shares are cumulative, non-cumulative, and convertible. Cumulative preference shares are those preference shares. If you do not pay dividend, the dividend gets accumulated and it can be paid at a later stage. That is called a cumulative preference share. Convertible preference share, on the other hand, can be converted into equity share at some future point of time. So related to preference shares, you have to understand, they may ask you what is a preference share. They may also ask you the type of preference share. And third, they may ask you what is a hybrid instrument. The next is, how do you value preference share? So preference share has two types of cash flows, the constant dividend and the maturity repayment or redemption. So when you talk about redeemable preference share, basically an investor buys the share today. He will receive constant dividend for a long period, and on maturity, he will receive the principal repayment back. So you have to discount dividends separately, and you have to discount the purchase price or the redemption price, not purchase price, but the redemption value separately. The current preference value is function of all dividends of future discounted to present, and the face value or the redemption value discounted to present. So this formula actually discounts dividend separately, which is constant, and the principal repayment also separately. So preference has the same valuation mechanism as debt. In debt, you have interest which is fixed, and on maturity, you will receive the principal repayment. In preference also, you have fixed dividend, but on maturity, you will receive the principal repayment in form of the face value. So that is the difference. The next is equity. So equity valuation is a very common question asked in all analytics profile or any equity valuation or stock market related profile. And one of the common ways the equity is valued is by applying something called a dividend discount model. So there are so many methods to value equity, but we are going to discuss two main methods which are frequently used and frequently asked also in the interview. Before we move to dividend discount model, we have to understand what is dividend capitalization approach. So expected return on any asset, especially a stock, is function of two things. Number one, the dividend that you are likely to receive, and second is called the capital appreciation. So let's say you buy the stock at $100 today, and after 1 year, the value is 110. So 110 minus 100, $10 is the capital appreciation. Plus, meanwhile, if you're receiving $5 of dividend also, so $10 of capital appreciation plus $5 of dividend, that is called $15, divided by the original price of $100. So 15% is your expected return. So dividend capitalization approach tells you that expected return on stock is function of dividend as well as the expected capital appreciation. Now, capitalization rate could also be found if you are using something called a Gordon's growth model or a constant growth model. So this is the formula of Gordon's growth model, where price is function of next year's dividend divided by R minus G. So R is the capitalization rate, G is the growth rate. So manipulating it little bit, R, the capitalization rate, is function of dividend plus P0 plus G. So you can find the required rate of return using the capitalization rate also. Now, let's understand what is a dividend discount model. So dividend discount model is basically, as its name suggesting, you are discounting the dividends to find out the price of the stock. So dividend discount model is called an FCF valuation method. FCF stands for free cash flow valuation method. There is something called DCF method, which is very common, discounted cash flow. So in discounted cash flow method, you discount the cash flows generated by an asset and bring them to present. So in dividend discount model, the stock value is present value of all future cash flows associated with it, mainly dividend. So dividend discount model is basically computation of today's stock price, which states that share value equals to the present value of all expected future dividends. So if you want to find the price of stock today, what you need to do is you have to find the present value of all future dividends plus present value of expected selling price. Let's say you want to find for 3 years. So you have to calculate the dividend for the first year. You have to estimate the dividend for the second year. You have to estimate the dividend of the third year and the expected selling price at the end of third year. And then you have to discount all of them to put it in the present value, right? H is the time horizon. So in dividend discount model, you project the future dividends, the future selling price of the share, and discount them back to present to find the present value of the stock. So that is the application of dividend discount modeling. It is also called DCF, discounted cash flow method. The next is relative valuation. So in relative valuation, the value of any asset is compared to the values assessed by the market of similar or comparable asset. So the main difference between the DCF valuation and relative valuation is, in DCF valuation, you value the asset based on its characteristics of cash flow and discount rate. Whereas in relative valuation, you are trying to value the asset based on the similar and comparable assets value. So you're not trying to value this asset, but you will try and value the asset based on the similar assets value. Need to identify the comparable assets and obtain the market value of these assets. Let me give you an example just to clarify how it works. Let's say you're interested in valuing the share of TCS. So there are two ways of valuing the TCS share. Either you discount the dividends of the TCS and find the present value and value TCS, or you may also find the value of TCS based on the similar company, which is Wipro. So what you're going to do is you will value Wipro, you will use those multiples to value TCS. So the fundamental difference between DCF valuation and relative valuation is, DCF valuation is a cash flow based valuation where you discount the future dividends and find the stock price. Whereas in relative valuation, you find the value of similar or comparable asset, use the multiple and value your own share. Now, first, convert the market values into standardized values. Since the absolute prices cannot be compared, this process of standardizing could be used by calculating something called multiples. So there are two multiples which are frequently used in valuation, in relative valuation. One is called price to earnings multiple, PE ratio, right? And second is EV to EBITDA multiple, enterprise value to earning before interest, tax, depreciation, and amortization. These are the most frequently used multiples in valuing the stock. Compare the standardized values and multiple for the asset being analyzed to the standardized value of the comparable assets. So this is how the price to earnings multiple is compared. So you start with earning before interest and tax, adjust for the financial items tax, so you will get something called an earnings, or the final earnings, yeah. And you have something called an enterprise value, value of financial assets, and value of debt. So you have something called price to earnings ratio. So one of the frequently asked questions in the interview is, what is a price to earnings ratio? So price to earnings ratio shows the relationship of, for every $1 of earning, how many times market is valuing your share. That could be called a multiple. A high PE multiple means market is valuing you more compared to your earnings, and a low PE multiple means market is valuing you less compared to your current earnings. So price to earnings ratio actually shows you the relationship between the current market price of the share of the company divided by the earnings per share of the company. Higher the multiple, more markets are valuing your earnings. Lower the multiple, less the markets are valuing your earnings. Right? So that is about the stock and bond valuation. So what are some of the stock valuation method? What is bond? What is YTM? How bond can be valued? What is the relationship between the interest rate and bonds? These are some of the questions you may expect. Now, the most important topic on which generally a lot of questions are asked. So what that is called risk and return. So what could be the risk? So a dictionary meaning for a risk is a hazard, a peril, or an exposure to loss. That's a dictionary meaning. But when you are talking in point of view of finance or in terms of finance, risk in finance is when the actual return of an asset is different from an expected return. Let me just give you a simple example to clarify. Let's say you're investing in a fixed deposit of a bank, and bank promises you 10%. So after 1 year, you are going to definitely receive 10% because generally fixed deposits are safe. But if you're investing in a stock of a company and then you expect 20%, it may happen that actual return could be less than 20% or actual return could be more than 20%. So assets where expected return and actual return are same are called less risky asset or risk-free assets. And assets where actual return could be far different from the expected return are termed as risky assets. So risk in finance is defined as if an asset has a different actual return compared to expected return, asset is said to be a risky asset. Now, how you can analyze the risk of an asset? So, number one, an asset could be analyzed based on a investment within that asset. For example, you are only investing in that asset, and the risk can be analyzed in terms of portfolio also. So, one of the frequently asked question is, what is portfolio? So, portfolio is basically basket of assets. When you invest in more than one asset, technically it is said that you have constructed a portfolio. So let's say you are investing in stock, bond, gold, maybe real estate and commodities. Then you have created a portfolio of the asset. And if you're only investing in stock, then it is basically a single asset. Now the most important thing is risk on a standalone basis, which is basically when you measure the risk of a single asset, you are actually measuring the risk of an individual asset. So it is measured by the variability of actual return over expected return. The statistical measure for variability is called standard deviation. So higher the standard deviation of the returns of any asset, riskier is the asset. So when you want to evaluate two assets, let's say asset A and asset B, and you would like to know which asset is risky, you simply calculate the standard deviation of both the assets. An asset with the higher standard deviation is likely to be more risky. So if you want to know the risk of any asset, you have to calculate something called a standard deviation of the asset. Now, the problem is if you want to calculate the risk of any asset which is invested in the portfolio, then there is a problem because portfolio is basket of assets. And the risk of any individual asset in the portfolio is the risk it brings to the fully diversified portfolio. The risk of any individual asset in the fully diversified portfolio is measured by the beta. So the most frequently asked question is, what is beta? Right? So beta is basically sensitivity of change in stock price compared to change in market price. It is measured as covariance of stock and market divided by variance of market. Now, the very basic answer to the question, what is beta, is it is a measure of sensitivity of change in the stock price compared to change in the overall market movement. Beta could be more than 1, beta could be less than 1, the beta of market is 1, right? Beta is one of the input in capital asset pricing model. There are two types of risks. One is called the market risk and second is called the asset specific risk. Market risk is those kind of risks which applies to virtually all assets. For example, inflation or political instability or corona pandemic. These are called market risk, which applies to almost all the assets. And asset specific risk is only applicable to a particular asset. For example, if you're investing in equity share, then the risk is only asset specific. If you're investing in gold, then the risk of investing in gold is asset specific. Now, market risk is risk applied to all the assets, whereas asset specific risk is risk applied to a particular asset. The next term which is generally asked is called portfolio diversification. So market risk basically cannot be diversified, but asset specific risk can be diversified by investing in more than one asset. Let me continue with the example. Let's say you have invested only in gold. So the asset specific risk, you are exposed to something called an asset specific risk. So you have invested in gold. Now, if you want to diversify that risk, an asset specific risk, you should invest in gold as well as fixed deposit, as well as equity, as well as mutual fund. So an asset specific risk can be eliminated by doing something called portfolio diversification. So again, one of the frequently asked question is, what is portfolio diversification? So portfolio diversification is process of investing in more than one asset class to diversify, reduce the risk. So if you invest in more than one asset, you can reduce the risk because all assets are not perfectly positively correlated. When the stock market goes up, the bond market or gold market may go down. And when the stock market crashes, the gold market may go up. So here you have to understand the portfolio diversification is the process of investing in more than one asset. The capital asset pricing model is the model used to find out or calculate the expected return on an asset if you know what is the measure or what is the level of market risk that an asset has. Now, before you move to capital asset pricing model, let's just understand. Investors are only rewarded for taking the market risk because they cannot diversify it. Investors can diversify the asset specific risk by investing in more than one asset or by portfolio diversification. So number one is investors are only rewarded for taking the market risk. Now, capital asset pricing model gives you an expected return on an asset if you know its market risk, the beta. So the formula of capital asset pricing model is risk-free rate plus beta times RM minus RF is called market risk premium. RM is return on market, RF is risk-free rate, and beta is the sensitivity of stock returns to market return. Beta is also called the measure of market risk, right? The market has beta of 1. If the stock has more than 1 beta, then it is considered to be a risky stock. If the stock has less than 1 beta, it is considered to be less risky stock compared to market. So one of the most frequently asked question is, what is a market risk? What is an asset specific risk? What is portfolio diversification? What is capital asset pricing model? So these are some of the questions that you need to keep in mind, that how you're going to answer those questions. The next is cost of capital. So what is cost of capital? So cost of capital is the price that firm has to pay for using money provided by the investors. So when you start your firm, you may use the money provided by equity shareholders. You may use the money provided by the debt holders, and you may also use the money divided by preference shareholders. Now, whenever somebody is investing in your firm, they expect some return. So for them, it becomes a return, but for you, it becomes a cost of capital. So if I'm an equity shareholder in, let's say, Reliance, so my expected return will become the cost for Reliance. So cost of capital is basically the price that firm has to pay to the investor for using their money. So it's basically the way of rewarding investors. Now, the rate of return required by all the investors will be overall return public weighted average cost of capital. So this is the formula for weighted average cost of capital. So weighted average cost of capital is function of weights of different components. Now, components could be equity share, components could be preference share, and component could be debt. So you need to calculate the weight of different components, and you also need to calculate the expected return by different components, and then you put it into the formula that is called weighted average cost of capital. So WD stands for weight of debt, percentage of company funded by debt. Weight of preference is basically percentage of company funded by preference share. Weight of equity is percentage of company funded by equity shareholders. Then you have something called post-tax cost of debt, cost of preference, and cost of equity. So remember, what is weighted average cost of capital? It's the weighted required return by providers of the capital. How do you calculate? So you use the different weights, and then you use the different cost of equity, cost of preference, and cost of debt. Now, related to that, most frequently asked is, how do you calculate the cost of debt? So there are basically 4 ways, 4 methods. Number one, check what interest rates banks are quoting on the loan. So if you're going for a loan and you ask bank that at what rate you're going to give me the loan, And if the bank replies 10%, then your cost of debt becomes 10%. Second method is called accounting method. In accounting method, you calculate the interest paid in a given year and divide that by total debt. So interest paid, you will get it from the income statement, and total debt, you will get it from the balance sheet. Calculate the ratio. What you will find is cost of debt. Third, the most important is bond. So if bonds are rated or traded, then you can calculate something called a YTM or yield to maturity. And finally, the fourth method is all bonds are rated. If they are rated, then probably you can calculate the interest rate for a particular rating, and that will become the cost of debt for you. So basically, if you have to define what is cost of debt, so cost of debt is the current cost the company has to pay to use the debt. It could be a YTM, it could be a rating based interest, it could be a quoted bank interest, or it could be a calculated accounting based interest. But ultimately, the interest that you're supposed to pay is the cost of debt. So that is number one. How can you calculate the cost of debt? Number two, cost of preference shares. There are two kinds of preference shares. One is called irredeemable preference share, where you don't have to redeem it. You just have to keep on paying the dividend and shares will be there forever. And there is something called redeemable preference share, which is very common. So for redeemable preference share, the cost of that preference is the discount rate. So discount rate, which makes present value of dividends and market price of the or redeem price of the preference equals to the current price, is the cost of preference. So cost of preference, if somebody is asking what is cost of preference, cost of preference is the discount rate which makes present value of all future preference dividend plus the redemption price equals to the current trading price of the preference share. That particular discount rate is called the cost of preference. Generally, people don't ask related to preference in the interview, but yes, how can you calculate the cost of equity? So that is very important. How can you calculate the expected rate of return on equity or cost of equity? So there are two models which are frequently used. First is called the capital asset pricing model, or CAPM. The second is called the DCF model, which is called discounted cash flow model. So the CAPM formula is very simple. Risk-free rate beta times RM minus RF, or the market risk premium. DCF is required rate of return on the stock is function of dividend divided by price plus the expected growth rate. So there are two ways of valuing or finding the cost of equity. One is called the DCF model and second is called the CAPM model. The next could be related to the working capital. So there are two terms which are frequently used: working capital and net working capital. I'll tell you the difference. Working capital is basically investment in current assets. So whatever is the total of your current asset, that is called working capital, and net working capital is current assets minus current liabilities. So that is called net working capital. Working capital is basically money that company needs to run the day-to-day business. That is called working capital. Now, if you want to know how much net working capital requirement is there in your business, what you have to do is current assets minus current liabilities. That will be the requirement of net working capital. How much short-term cash does the company need to pay its bill? That is called the net working capital. There's also one thing that you need to understand, that is called operating cycle. Now, operating cycle will actually decide how much working capital you will be needing. So let's just understand what is operating cycle. So let's say there are 4 important dates. On this day, you purchase the inventory. On the second day, you pay cash for the purchase. On the third day, the inventory is sold. And on the fourth day, cash is received from the customer. Let's say these are the events happening. Now, from the day inventory is purchased till the day that you pay for the purchase, the difference between these two dates is called account payable period. Let's say you purchased inventory on the 1st and you paid cash on the 7th. So accounts payable period is 6 days. The day you purchase inventory, and you sold the inventory, the difference between these two dates is called inventory. The day you sold inventory and you received cash from the customer, difference between these two periods are called accounts receivable period. And finally, from the day you received cash and you paid cash, so from the day you paid cash till you receive cash, that period is called the cash cycle. In the entire period, inventory purchase to cash received from the customer is called operating cycle. So operating cycle of the business starts from the basic activity, from production, and ends up in the cash, right? So that is called an operating cycle. Sometimes they may ask you the question, what is operating cycle or what is a cash cycle? And what is the relationship between operating and cash cycle? Or would you want a larger, longer cash cycle or a shorter cycle? So when you go back, just look at your notes or details, right? So cash cycle is basically operating cycle minus accounts payable period. So if you have an operating cycle and you remove accounts payable period from operating cycle, you will get something called the cash cycle, right? Finally, they may ask you what are some of the sources of working capital finance, how you can finance your working capital. So some of the options are loans from the commercial banks, public deposits, trade credit, factoring. Factoring is basically financing against receivables. So you have receivables, some people may find or fund you against those receivables, and bills discounting, bank overdraft or cash credit, and advances from customers and accrual accounts. So these are some of the options through which you can finance your firm, right? So just to review, there are some topics that you need to focus on when you go and review the basic financial management textbook before you appear for any interview. So the topics that you need to go through is, one is time value of money, second is valuation of stock and bond, third is risk and return, right? Fourth is weighted average cost of capital or cost of capital. Fifth is probably the working capital. And there's one more topic which is left, that is called the capital budgeting method, right? So let me share this one more PPT. So capital budgeting is basically the process of finding out which projects you should invest in, right? So let's just talk about it. Just wait for a few seconds. So principally, whenever they are going to ask you questions related to capital budgeting, they're going to ask you the methods of capital budgeting. And the methods of capital budgeting basically are the NPV method, the IRR method, the payback method, the discounted payback method, and the accounting rate of return method, right? So we're going to discuss the two important ones. The NPV method is net present value method, and the formula for calculating net present value is present value of inflows minus present value of outflows. That will give you the NPV. And IRR is the discount rate, which makes present value of cash inflows equal to the present value of cash outflows. So NPV, IRR, the feature of NPV, IRR, then payback period. Payback period is the length of the time required to recover the initial investment. Then you have something called an accounting rate of return. So go through all the capital budgeting methods and their nitty-gritties, right? So with this, I end it.
So the next topic that we're going to discuss is capital budgeting, right? So capital budgeting is the process of making decision regarding the capital expenditures in projects or assets. Capital expenditure is generally for acquiring capital asset which are used in the business. They are not purchased with the intention of resell, and such assets would give us benefit for a very long period. So any expenditure done to acquire capital assets can be counted as capital budgeting. The example could be land, plant, and equipments. Now, what is the importance of capital budgeting? So the most important thing about capital budgeting is it involves heavy investment. Most of the capital expenditures that you do involves substantial amount of outlay. Second is permanent commitment of funds. So once you initiate a capital budgeting project, you'll have to invest the funds for a very long period. Third, long-term impact on the profitability. If capital budgeting decision is not right, one wrong decision may affect the long-term profitability of the firm. And fourth is irreversible in the nature. So most of the capital expenditures are generally irreversible. So once you commit to those expenditures, it is generally difficult to reverse them. Now, what is a capital budgeting process? So capital budgeting process starts with finding the right projects. Generally, managers get the application from different departments, or they also have to spend some time in finding the projects. Second, once you find the project, determine the relevant cash flow from the project. That's where the free cash flow to the firm and free cash flow to the equity equation will come into the picture. Third, determine the risk of those cash flows. So depending upon the risk, you can identify the right hurdle rate. It could be cost of equity or weighted average cost of capital. Choose budget, how much you want to spend the money, and finally, post audit, after investing in capital budgeting. In the hindsight, you may evaluate whether this capital budgeting decision was successful or not. Now, some of the important rules when you try and talk about cash flow is, number one, discount cash flow, not accounting profits. Accounting profits are suffering from two limitations. One, they include non-cash charges like depreciation and amortization. And second, according to an accrual concept, the profit may not be equal to cash flow. So you may spend profit, but you will not be able to spend the cash flows. Second, time period of cash flow is important. Earlier cash flows are more preferred compared to the later cash flow. Third, consider opportunity cost. Opportunity cost is the cost foregone by taking the project and not investing in the second best alternative. So the project has to ensure that the return foregone has to be delivered by this project. Fourth, consider the tax implication of the project. And fifth, ignore the sunk cost. Sunk cost is basically the cost which is already incurred. You cannot recover it. So while evaluating a new project, the cost already incurred should be ignored from the consideration of the capital budgeting. Now, how do you calculate the cash flow? So you start with revenues minus expense minus depreciation will give you profit. You add back depreciation and amortization as it is a non-cash expense. Adjust for net capital expenditure. Adjust for any net working capital requirement. You will get something called a free cash flow to the firm or cash flow. Now, let's start with the capital budgeting method. So the first method is called the payback method. So payback period is the length of time required to recover the initial outlay. For example, the initial outlay was 6 lakhs and you're getting 2 lakhs, 150, 150, 1 and 150 in 5 years. So here the payback period is 4 years because you are actually recovering the 6 lakh at the end of the fourth year. 2 plus 3, 5 plus 1, 4. So 4 year is the payback period. Now, what is the decision criteria under payback method? Accept the project with the shorter payback period compared to the threshold payback period. So if your payback threshold is 5 years and any project's payback less than 5 will be accepted. It is advantageous because it is easy to calculate. Disadvantage, it ignores the time value of money. Cash flows are not discounted. And it ignores the cash flow beyond payback period. Next is discounted payback. All cash flows are calculated taking into consideration the appropriate discount rate. So all initial outlays first are discounted and After discounted, you calculate the discounted payback. So in this case, it takes into consideration the time value of money. The next is accounting or average rate of return method. So ARR is average annual profit divided by original investment into 100. This method takes into consideration the accounting profit, not the cash flow. So in this case, the average annual profit was 1,50,000 divided by 6 lakh. So 25%. The rule in ARR is very simple. Accept the project if accounting rate of return is higher than the required rate of return. The advantage is it is simple to calculate, no estimation required. Disadvantage, it is based on the accounting profit, not the cash flows, and it does not take into account time value of money. The next is the most frequently used method, which is called net present value method. So decide an appropriate discount rate. Present value of estimated cash flows includes inflows and outflows. The equation of NPV is present value of inflows minus present value of outflows. The criteria of selection under NPV method is accept the project when NPV is greater than 0 and reject the project when NPV is less than 0. So in this example, we have calculated NPV at the rate of 10% and the answer is 10,124. And since the NPV is greater than 0, we'll accept the project. The advantage of net present value is it takes into account the time value of money. So all cash flows are discounted with the appropriate discount rate. Second, it has an additive property. So NPV of two projects can be added. Disadvantage, it is in absolute terms, not relative terms. So NPV will give you a dollar value, but it does not take into consideration the initial amount of investments. So it may happen that one project will have a higher NPV, but it will also have a higher investment. Next, it is biased towards long-term project in case projects are mutually exclusive. So mutually exclusive projects are those projects where you can take one of the projects. And NPV is generally biased towards projects which has long-term period or timing. The next is profitability index or PI or excess present value index method. So PI is present value of future cash inflow divided by present value of future cash outflow. So in this case, at 10% discount rate, the probability index is present value of cash inflow, which is equal to 1,10,000 divided by the initial outlay, which is 1 lakh, so 1.1. The criteria for decision under this case is accept the project if profitability index is greater than 1, reject the project if profitability index is less than 1. The advantage of profitability index is it takes into account time value of money, it takes into account the scale of investment, and it is used when the capital is limited. So when you have limited capital, you'd like to invest in the project, which will give you higher profitability. So that's where the profitability index method will come into the picture. The next is internal rate of return. So internal rate of return is the rate of return or the discount rate, which makes present value of all future cash inflows equal to the future cash outflow. In other words, if you discount the project's cash flow at the appropriate IRR, NPV will be 0. IRR, cash inflows divided by cash outflow, should be 1. The methods for calculating IRR is trial and error, or you can use the Excel. So if this is the example, the IRR for this example is 12%. The decision criteria for IRR is accept the project if IRR is greater than the required rate of return by the investor. Advantage, it takes into consideration the time value of money, and second, it gives the same result as given by the NPV. However, IRR is suffering from certain disadvantages. Number one, it assumes that all intermediate cash flows are reinvested at IRR, which gives an optimistic picture of the investment return. Second, IRR does not differentiate between negative and positive cash flows. It means it will not differentiate between borrowing and lending. Third, IRR in case of negative cash flows followed by one more negative cash flows will be a misleading measure. For example, in this case, there is a negative cash flow followed by positive cash flow and the negative cash flow. So there are more than one negative cash flows. In this case, you will have something called a multiple IRR. In case of mutually exclusive projects, sometimes IRR may give you an optimistic picture, but NPV will give you the right picture. So the $1 million question is, if you are considering two projects, projects A and B, where project 1 is preferred by IRR and project B is preferred by NPV, which one you should select? The correct answer is you should always select the project which is preferred by the net present value. In order to limit the limitation of IRR, which assumes that all intermediate cash flows are reinvested at IRR, there is a modified IRR function. So modified IRR assumes that all intermediate cash flows are reinvested at cost of capital, not IRR. So MIRR is basically future value of positive cash flows and reinvestment rate divided by present value of negative cash flows and financing rate. So here financing rate and reinvestment rate are different. So this ends the story of capital budgeting. So when you appear for the interview, they may ask you about certain capital budgeting methods, the equation, the decision criteria. The most frequently asked questions are on NPV and IRR. So I hope the capital budgeting topic helps you in understanding the broader concept of capital budgeting. So we close here with the second session. Thank you very much and wish you all the best.